Let's have a look at lump sums. Lump sums could be received from either an employer or a retirement fund. Lump sums received from a retirement fund will either qualify as withdrawal benefits, where we will use the withdrawal benefits table in order to calculate the tax, or retirement benefits, where we'll use the retirement benefits table to calculate the tax. Lump sums received in terms of a divorce order are seen as withdrawal benefits. Lump sums from an employer could be included as normal taxable income. However, if these lump sums qualify in terms of being a severance benefit, then we will see them as a lump sum and treat them as a retirement benefit using the retirement benefits table to calculate the tax thereon. The lump sum tables you will get in Silk or in your Act, and that will also be provided for you in the annexure. It's important to be able to identify which table is the withdrawal benefits table and which one is the retirement benefits table, as this will obviously affect the calculation of your tax. The calculation of the tax on lump sums on assessment, we need to calculate what's the normal tax liability on these lump sums. The first step is to calculate the aggregate net lump sums for a lifetime. So that means we need to accumulate all lump sums that the individual has received over their lifetime. But remember, it's only the taxable part of the lump sum, so the net lump sum. Secondly, we need to calculate the tax on the aggregate net lump sum. So in other words, we're calculating the tax on the cumulative taxable lump sum. We will either use the withdrawal benefits table or the retirement benefits table, depending on what is the last lump sum, so the latest lump sum that we've received. What is that? If it's a withdrawal, we'll use the withdrawal table. If it's a retirement, we'll use the retirement benefits table. Thirdly, we need to calculate any prior aggregate net lump sums. So in other words, any previously received lump sums, we're going to accumulate those together, and we're going to calculate a hypothetical tax on these prior aggregate net lump sums based on the same table as what we used in step 2. So if it's a withdrawal benefit for step 2, in step 4, when we're calculating the hypothetical tax, we also need to use the withdrawal benefits table. The same if it's a retirement benefit in step 2, where we aggregate all the lump sums for the entire lifetime, we need to use the retirement benefits table on the aggregate of all previously received lump sums. This hypothetical, this reduction or this deduction that we get in terms of a hypothetical tax is just that it's not real, it's notional. It does not have any impact, or rather the previously paid tax on any previously received lump sums will not impact this value. This value is calculated based on what was the cumulative lump sums that were received before the current lump sum, and if there is any tax that is calculated, there would be a deduction. We'll have a look at an example which will help to explain this. The amount that's calculated will become part of our normal tax liability calculation. Lump sums that are received from employers should be included in gross income. However, if it is a severance benefit, and there is a definition for a severance benefit being any lump sum amount other than from a fund received from the employer in respect of the termination for office of the employment, if the person is older, is 55 years or older, or due to sickness or redundancy, then it will be a qualifying severance benefit. And if it's a severance benefit, it will be taxed in terms of the retirement tables. If it does not qualify in terms of these requirements of a severance benefit, then it will be taxed in terms of normal gross income and simply go into gross income and part of taxable income. It's important when you're dealing with lump sums to remember that lump sums regardless of whether it's from an employer or a fund, are included in taxable income. However, because we tax them on a separate table, it's advisable from an exam technique point of view to keep it in a separate column. However, let us know by writing included in gross income that you know that it is part of gross income. Lump sums received from a fund are also included in gross income. However, it is only the net amount that is included in gross income. The net amount is calculated by taking the gross amount of the lump sum received less any allowable deductions. Allowable deductions would be contributions that were not previously allowed as a deduction, amounts that are transferred to other funds, either because of a divorce order or in terms of moving from one fund to the other, any unclaimed benefits that have previously been taxed on transfer, and any exempt portion of a lump sum transferred from a public sector pension fund. As I previously mentioned, although lump sums are included in gross income and therefore taxable income, they should be kept separate in terms of the calculation because we use a different tax table other than the normal progressive tax. Normal tax liability on lump sums is calculated on a cumulative basis, and the following must be included. So the lump sum that is received plus severance benefits that received on or after 1 March 2011, plus withdrawal benefits received on or after 1 March 2009, plus retirement benefits received on or after 1 October 2007. So what this means is that when we are calculating the cumulative total for our lump sums, we need to include any other lump sums that we've previously received, provided they were received on or after these dates. Should we receive a lump sum, or should we have received a lump sum that was prior to these dates, it will not form part of the cumulative basis of calculating the tax on the lump sum. Always remember to deduct the hypothetical or the notional amount of normal tax in order to work out what the tax is on the lump sum. It's important to calculate separately on each type of lump sum received, but then again to do it cumulatively. So for each lump sum that we receive, we need to go and have a look at what amount would go into gross income, taxable income, which would obviously only be the net amount. Then we would need to go and have a look when we're doing the normal tax calculation on that lump sum. We need to cumulate all the prior lump sums that we've received. Let's have a look at an example. Here we're being asked to calculate both the taxable income and the tax liability of the lump sum for the year of assessment. Mr. J, who is 60, retired from the employment of XXX on the 31st of December. He received a lump sum of 4 million from the Provident Fund on retirement. Contributions to the Provident Fund that had not been allowed as deductions totaled 450,000 as at 31 December. So what's important to identify in this paragraph is that Mr. J is 60, but that he retired from employment. So that's telling me that this lump sum that he received would be a retirement lump sum. So when I'm calculating the tax, I must remember to use the retirement tax table. These contributions that were previously disallowed, you'll remember, are deductible from the lump sum received in order to get the net amount of the lump sum, or the taxable amount of the lump sum. The example goes on to say that on the 31st of November 2010, so in the past, Mr. J had received 300,000 lump sum from a retirement annuity fund. He was 53 years old at the time, and the retirement age for the RAF was 55. So what this is telling me is that this lump sum, when he received it in 2010, would have been a withdrawal lump sum, as he withdrew at the age of 53, where retirement age was only 55. There were no disallowed contributions, so this would in essence be my net amount of my lump sum for that previous lump sum. It further goes on to say, on the 31st of August 2008, Mr. J had received 120,000 lump sum from the pension fund at his previous employer. At the time, he was younger than retirement age, so therefore this would also be a withdrawal lump sum. There were no disallowed contributions with regards to this pension fund lump sum. What's important to remember is the date on which this lump sum was received, 31 August 2008. If we go and have a look at what are the dates in terms of when we must accumulate, would this fall into it? So if we have a look, we're looking at a withdrawal benefit because he was younger than retirement age at the time, and we only include withdrawal benefits that were received on or after 1 March 2009. This lump sum was received on the 31st of August 2008, so that is before. Therefore, this 120,000 of the lump sum will not be included in my cumulative lump sum total when I'm calculating the tax liability portion. Remember, it asked us to calculate the taxable income and the tax liability. So the first step would have been to take the lump sum minus any allowable deductions. In this case, it was the disallowed contributions. Therefore, my taxable portion of the lump sum, or my net lump sum, that would go into taxable income, into gross income, is this 3.55 million. Now we need to go and have a look at what is the tax on this lump sum. The first thing we need to do is have a look at accumulating all our lump sums. So as mentioned while we were reading through the information, we have our provident fund, the net lump sum that we worked out. We also have the 300,000 that we previously received from the RAF. And we're not going to include any amount for the pension fund, that 120,000 we received from the pension fund, because it was before the date for accumulating lump sums. Therefore, our total lump sums that were received by Mr. J for his lifetime amount to 3.65 million. It is this amount that we then need to go and apply the retirement table to and work out what the tax is on the cumulative lump sums. So once we've applied the table, we'll end up with the taxable amount. From this amount, we must then go and reduce it by the hypothetical tax on all prior cumulative lump sums. So that only leaves the 300,000 from the RAF. However, remember, when we are calculating what the tax is on this 300,000 for the hypothetical, we must use the same table. So if we use retirement table on the cumulative, we must use the retirement table for the hypothetical. Because the 300,000 is below the 500 on the retirement table, there will be no tax seen in terms of this hypothetical tax of the 300,000, and therefore there will be no deduction in calculating the tax liability on this lump sum. So if you think about it, this 300,000 that was received from the RAF, there was actually tax paid on it. Remember, it was a withdrawal benefit. He was younger than the retirement age at the time that he received it. He was 53, retirement age was 55. Therefore, when he received this 300,000, he would have had to actually pay 49,500 rands tax on it. However, now when he is getting this lump sum on retirement, he doesn't actually get the benefit of having paid that tax in the past. So SARS does this in order to encourage you not to withdraw your lump sums or your retirement funds, so that you rather keep those funds for when you do actually retire. Because if you withdraw out of your lump sums and you don't, let's say, reinvest in a preservation fund, then SARS is concerned that you wouldn't then have enough actually to sustain you for retirement, and then you'll become a drain on the fiscus. Therefore, he is encouraging you by, in essence, penalizing you. If you do withdraw, you pay tax, but that means then when you one day retire, you might actually not get any benefit for previous taxes that you've actually paid on lump sums. Thank you. This is the end of lump sums.